Hey, this is Tom, and many years ago when I was a kid, we had a family get-together and my Uncle Dima got into a fight with my Uncle Ludmilla about some money stuff. I don't remember what happened, but chairs ended up flying, whole Olivier salads flew across the room. It was a complete pandemonium. I've never been more scared in my life until I saw this market. This market scares the living crap out of me. It's absolutely terrifying, not because it's down, because the way it's behaving. Just Thursday, the Dow saw its biggest spike since 2020. And then just a day later, the biggest downswing in a day since 2020. And that's all within 48 hours. That sort of volatility, that sort of behavior makes me just want to say, hey, I'm out. See you later. But you don't have to do that. Obviously, you can always go to cash and sit this one out. And it's not necessarily a bad bet. Obviously, you're going to take a hit on inflation, but you're going to be completely insulated from the insanity of this market. Look, yesterday we saw some crazy numbers. Dow was down 3.1% on the day. The S&P 500 3.5% on the day. Nasdaq down 5% on the day. Bitcoin is down to $37,000. The yields are going about 3% for the 10-year bond. And may I remind you, the yields go up when the prices go down. So everything is spiraling downwards on this insane day we saw. However, in this video, like I promised, this was not clickbait. I'm going to show you how you can still walk away with 7.5 to 20% within the next 6 months to a year with very moderate risk, definitely compared to what's going on in the equities market right now. And no, I'm not selling any courses or cryptocurrencies or any scams of that sort. I'm talking about playing blue chip equities in a way that eliminates a lot of this market risk with quite nice returns, definitely in this market. So this is something that the hedge funds have been doing for years. It's a very known strategy, but I believe in this market, given the two deals we have right now on the table, it's very lucrative. Now, again, this is not financial advice. I'm not a financial advisor. I'm not just saying this for a disclaimer. I'm literally saying this so you guys go and get some professional advice before you make any investment decisions. And obviously, you have to do the research for yourself. I'm just here to give you some ideas about my own research. So let's get started. So let's do this in two parts. In part number one, I'm going to show you why the macro environment is just too hot right now to get into some new investments, at least in equities. And in the second part, I'll show you how you can insulate yourself from this macro environment and get 7.5 to 20% within the next 6 months to a year with very minimal risk, according to my own opinion, of course. So let's get started. First of all, look, it's not a very hospitable environment now for equities. And as the Federal Reserve will increase interest rates more and more, and it's going to get worse, because the other thing the Fed keeps doing while increasing the rates is actually buying less bonds in the market. So there's a liquidity crisis beginning to form. Less money in the system, higher interest means less liquidity, less lending, less activity, basically screeching the economy to a halt. It's a very dangerous development. And at these macro environments, people are basically saying, hey, I'm going to wait it out, at least institutionals and big investors. And some of you may say, well, Tom, maybe the Fed will stop this. Maybe they will not be increasing rates all that much. Well, for that to happen, we have to see some decline in the inflationary environment. And right now, it's going into the opposite. You've got oil price going to $110 per barrel. You have supply chain shortages. China is locking down, creating even more supply chain shortages. Geopolitical crisis in Ukraine, wars, massive global deglobalization processes, not to mention the fact that our own job market is boiling hot with under 4% unemployment and a wage growth that also is adding to inflation. So every little factor that you can think of right now is making inflation worse. So it's very unlikely that the Fed will have an option not to raise interest rates given all these circumstances. And when the rates will go up, eventually what it will do is that future valuations of profits will suffer because these interest rates represent also the cost of capital. And that means that tech companies are going to take a massive hit, but everybody else, every company has future profits. Everything is going to take a massive hit because of this liquidity crisis, because of inflation, because of increase in rates, because of devaluation of future profits. Everything is going to be pushing down. So the macro environment, I think we can all agree, is not looking good for the next 6 months to a year. However, not everything is doom and gloom. We have a solution, as I promised, to make 7.5 to 20% within 6 months to a year with little risk, actually insulating you from this macro environment. Check this out. There's two deals on the table right now that can allow you to get 7.5 to 20% within 6 months to a year with little risk. And those are the Twitter acquisition and the acquisition of Activision by Microsoft. In these two deals, there's a big risk arbitrage element built in, and I believe this risk arbitrage does not represent how much money you can make on these deals. For example, you can make 7.5% on the Twitter deal if you buy it now and wait until Elon Musk actually pays $54.20 per share when he actually completes the deal. That's 7.5%. Now, may I remind you, I said this before when the gap was 10%, and those of you who listened already made 2.5% that deal. I'm just saying, it's only going to get closer and closer to $54.20 as Elon raising more capital and as the deal becomes more and more probable. This is a deal, and I made a whole video about it. I'm going to put it right here, explaining why there's almost no risk in this deal except for Elon backing out of the deal or not getting any funding. And as you can see, funding is being achieved, and Elon doesn't seem like he's about to back out. In fact, he just said he's going to be the interim CEO for a while. So this deal is a very likely deal to happen. The time frame is 6 months. By October, they got to close. So you're looking at about 7.5% for 6 months. And this macro, very interesting. The other deal is the acquisition of Activision by Microsoft. Warren Buffett made a huge bet on it, $5.5 billion bet. Currently, the price is below $80 per share, $78 per share. The deal price is $95 per share. So that means you're looking at a gap of about 20% while this deal actually is pending. Now, of course, the bigger gap actually represents bigger risks because this is a 1-year deal. In fact, it should close by June 2023. So you have over a year of wait time, double the time of Twitter, and there's obviously double the risk because there are regulatory issues. There's actual FTC antitrust issues here. Lina Khan, the head of the FTC, there's a whole debate there. I made a whole video about that right here. I'm just going to put it again. And in this video, I explain to you why I think the risk is very low for this deal given the video game market and how this deal positions Microsoft in that market. And I'm not the one saying this. We have a professor from the University of Michigan, an expert to antitrust law, basically saying the same thing. All these antitrust experts are saying that the FTC does not have a case here. And even though they might go for it for the PR element, they're not going to win this case. So Microsoft, Activision, Twitter, both opportunities to completely insulate, because when you're buying into a risk arbitrage deal, when you're buying stock before the acquisition closes, all you need to look at is the probability of the deal closing. The macro environment becomes irrelevant. And what better time to create irrelevance in the macro environment and pick up your 7.5 to 20% within 6 months to a year. Now, of course, nothing is guaranteed. And if the deal falls through, you lose a lot of money. But all I'm saying, in this macro, with this risk profile on these two deals, it's very interesting. Now, let me know below if you want me to do more of these or less, whatever it is. Comment below. Thank you for the channel members. Thank you for Patreons. I'll see you tomorrow.